Quick question. When do you think was the last time emerging markets were this cheap compared to the United States? The answer, 55 years ago in 1969. That was the last time that the relative price performance fell to -1 standard deviations. Forecasting a trend change of this magnitude, it is always risky, but in this video, I want to present a compelling case for why emerging markets are due to outperform. Hey everyone, Brian here. I write EWI's monthly European financial forecast. A big part of the bullish case for emerging markets relates to some videos I posted in June. Back then, we looked at gold prices and commodity prices, and we also looked at interest rates. Premise being that we're in the early stages of a rotation from financial assets to hard assets and to cash. I'll explain the connection to emerging markets in a minute, but we can set the stage with this chart. Top graph, Bloomberg Commodity Index, bottom graph, 10-year Treasury yields. Both are in the early stages of a big advance. And that time period near 1969, that is important that you are here label. That was the start of the explosion in commodity prices in the 1970s. The Elliott Wave structure today, it is a close cousin. First wave up, second wave counter trend. So the 1970s bull market in rates and commodities, pretty good generalized idea of what to expect moving forward. Now, this chart analysis comes from my friend and colleague, Mark Galashevsky. Mark wears a lot of hats at EWI. He writes the Asia Pacific financial forecast, and he's also an emerging markets guy, and that kind of makes him a commodities guy by default because commodities play such a huge role in those economies. As a forecaster, Mark is not afraid to step out in front of a bus. That red quote on the chart, one of the most contrary and accurate forecasts I've ever seen. Commodities were left for dead in 2020. Mark got out in front and said, hey, look, major trend change, enormous upside for commodities, for price inflation, and for interest rates. Today, it's 5 years later. Top graph has doubled. Interest rates jumped from 0 to 5%. And right now, it's actually a good time to prepare for the next wave higher because we have corrected those advances. On that score, this next chart shows the bigger implications for emerging markets. This is another one that Mark recently published. Top graph, gold ETF, middle graph, materials ETF. So these are the biggest global raw materials producers. Bottom graph, the economies in the emerging markets ETF. This is the key here. All of these markets have been trending together for the past 15 years. Premise here, gold's breakout signals the start of the materials era and in turn, the rise of emerging markets. Now I'm painting this picture with a very broad brush. If you want the details, Mark just put out a special section in the latest global market perspective. It is a fantastic read. He goes deep into how this transition will affect information technology, tech shares, digital assets, Bitcoin and crypto, gold mining stocks. For my part, I'll just say it's hard to overstate the importance of this transition from a digital era to a materials era. These trends will play out over decades. I'm sure I'll be doing a lot more videos on this subject, so be sure to like and subscribe to our channel. And if you're serious about navigating these markets, check out the links to our full services in the description. Thanks for watching. See you in the next video.